Hello and welcome back to Asset Zenith, your guide to smart investing, financial knowledge, and strategies to grow your wealth. If you've ever wondered whether you should invest in ETFs or mutual funds, you're not alone. These two investment vehicles are incredibly popular, but they're also quite different. Choosing the right one can shape your financial future in very real ways. So today, we're diving deep into the world of ETFs and mutual funds. We'll break down what each one is, how they work, and more importantly, which one might be a better fit for your personal investment goals. Whether you're just starting out or looking to fine-tune your portfolio, this episode is packed with insights you won't want to miss. Let's start at the beginning. What exactly is an ETF? That stands for Exchange Traded Fund. An ETF is an investment fund that holds a collection of assets, like stocks, bonds, or even commodities, and it trades on the stock exchange just like a regular stock. When you buy a share of an ETF, you're essentially buying a slice of a larger investment pie. For example, one of the most well-known ETFs, the SPDR S&P 500, gives you exposure to 500 of the largest companies in the US, all in one simple trade. ETFs offer a few standout features. First, they're traded throughout the day. That means you can buy or sell them whenever the stock market is open, just like you would with Apple or Google stock. Second, they tend to have very low fees. Most ETFs are passively managed, which means they aim to track the performance of an index rather than beat it. That passive approach keeps management costs low. And third, ETFs are generally more tax efficient than mutual funds, thanks to a unique structure that helps avoid triggering capital gains taxes during normal trading. On the flip side, what is a mutual fund? Like ETFs, mutual funds also pool money from many investors to build a diversified portfolio. But the way they operate is quite different. Mutual funds don't trade throughout the day. Instead, they're priced once a day after the market closes. This price is called the net asset value, or NAV. When you buy or sell a mutual fund, you're doing so at the NAV price, not at a fluctuating market price like with ETFs. Another key difference is that mutual funds are often actively managed. That means a team of professional fund managers is constantly researching the market and making decisions on what to buy and sell in an effort to outperform the market. While this sounds great, it also comes with a cost. Actively managed mutual funds tend to have higher fees, often 1% or more annually. Some also have sales charges known as loads, which can eat into your returns. Mutual funds also commonly have minimum investment amounts, usually ranging from a few hundred to a few $1,000s. This can make them a bit less accessible for new investors. And because fund managers frequently buy and sell assets inside the fund, mutual funds can be less tax efficient than ETFs, especially in taxable accounts. Now let's compare the two side by side to give you a clearer picture. ETFs are flexible. You can trade them anytime during market hours. Mutual funds, on the other hand, only trade once per day. ETFs generally have lower fees, while mutual funds often cost more due to active management. ETFs are more tax efficient, whereas mutual funds may result in more taxable events. ETFs don't usually require a minimum investment. You can often start with the price of a single share. Mutual funds, by contrast, may require a minimum upfront amount. ETFs are fully transparent. You can usually see exactly what's inside the fund every day. Mutual funds typically disclose their holdings on a quarterly basis, which means less visibility for investors. However, mutual funds shine in retirement plans like 401ks, where they're commonly used and often come with simplified automatic features like dividend reinvestment. So, which one is better? That really depends on you. If you're a do-it-yourself investor who wants low costs, daily trading flexibility, and better tax efficiency, ETFs might be your go-to. They're especially attractive for younger investors and those who like to build and manage their own portfolios. But if you prefer to hand off the decision-making to professionals and don't mind paying a bit more for it. Or if you're investing through a retirement plan like a 401k, mutual funds can offer convenience, structure, and automatic features that make your life easier. They're ideal for people who want to set it and forget it. Let's address a few common myths. One common belief is that mutual funds always perform better because they're actively managed. But the truth is, most actively managed funds actually underperform the market over time, especially after accounting for their higher fees. In many cases, passively managed ETFs end up delivering better long-term results. Another myth is that ETFs are just for traders. This isn't true either. While ETFs can be used for short-term trades, they're just as useful for long-term investing. Many investors use ETFs to hold positions for decades, especially those that track broad market indexes. Some people believe mutual funds are safer than ETFs, but safety isn't about the fund type. It's about what's inside the fund. An ETF holding government bonds is less risky than a mutual fund filled with volatile tech stocks. Always look at the fund's contents before making a decision. And finally, there's the idea that you need a lot of money to get started. That might have been true years ago, but today, with ETFs and fractional shares, you can often start investing with as little as $10 or $20. Even mutual funds have become more accessible through retirement plans or certain brokerages with low minimums. So, how do you choose? Ask yourself a few key questions. Do you want low fees and full control over your investments? Then ETFs are likely a better match. Do you prefer professional management and automation? Then mutual funds may suit you better. Are you investing through a 401k or an IRA? Mutual funds are often the default choice in these plans, but that doesn't mean they're your only option. If you're just starting out, a broad market ETF like one that tracks the S&P 500 is a great low-cost way to begin. If you prefer a more hands-off approach, a target date mutual fund might offer the simplicity you're looking for. It's also perfectly okay to use both. Many investors have ETFs in their personal brokerage accounts and mutual funds in their retirement accounts. It's not an either-or decision. It's about what works for your strategy. In the end, both ETFs and mutual funds can help you build wealth and diversify your investments. They each come with pros and cons, and the best choice depends on your unique situation. What matters most is that you understand how your money is being invested, what it's costing you, and whether it aligns with your long-term financial goals. Now, we'd love to hear from you. Are you Team ETF or Team Mutual Fund? Which one are you using in your portfolio, and why? Drop your thoughts in the comments. And if you have a question or want us to compare other investment tools in a future episode, let us know. Your feedback helps us shape better content just for you. Before we wrap up, let's do a quick recap. ETFs offer low fees, trading flexibility, and tax advantages, ideal for hands-on investors. Mutual funds provide professional management, automatic reinvestment, and are widely used in retirement plans. Both offer access to a broad range of investments and can be powerful tools in your financial toolbox. Thanks for joining us today on Asset Zenith. If you enjoyed this episode and found it helpful, be sure to like, subscribe, and hit the notification bell so you never miss a future video. We're here to help you make smart decisions, grow your wealth, and reach your financial zenith. Until next time, keep learning, keep investing, and as always, stay Zen.